Great. Good afternoon or good morning, everybody. Thanks for joining us. Quick background on Richey May, if you're not familiar with us. 35 years in mortgage banking, focus on the mortgage banking industry, full suite of audit, tax, consulting services, and really focused on the mortgage banking side. And I'm really happy to be part of this session today with our friends over at Servbank who are sponsoring this presentation. We've got some great topics for you today. From the Richey May side, I'm going to introduce myself. I'm the Director of Mortgage Consulting here at Richey May. Been in the industry 27 years. And I'm going to provide some of the high-level stuff. I'm pleased to be joined by Mignon Davis, who runs our subservicing oversight group and our internal audit group here at Richey May, so she wears a lot of hats. So I'll let Mignon introduce herself, and then we'll turn it over to our friends at Servbank, and they can introduce themselves, and we'll get started with the presentation. So, Mignon, why don't you give everyone a quick background?
All right, thanks, Seth. My name is Mignon Davis, and I've been with Richey May for about 2.5 years. I am the director over internal audit and subservicing oversight, and I've been in the mortgage industry for almost 25 years now. So I've done a lot of different things, worn a lot of different hats, and now here I am. So thank you for joining today, and I'll kick it over to Servbank.
Hey guys, my name is Jason Kwasny. I am the Chief Servicing Officer here at Servbank. Excited to be partnering with with the folks over here at Richey May to present to you some great stuff today. And I want to thank all of you guys for joining today. Let me give you a little information from Servbank. You can see it on the screen here. We are a top 10 nation subservicer, number 4, Ginnie Mae, and we are an FDI insured bank subservicer as well. We really focus on creating excellence for our clients and customers by providing them the highest quality experience. With innovative solutions, we feature complete, and we believe in complete transparency, and obviously we deliver superior performance. This is all put together with our people, great people plus fabulous technology. We like to say that we have the best in class in teams and technology. If you guys haven't seen a demo of our award-winning SIMI, I encourage you guys to do so. Again, it offers complete portfolio transparency, on-demand reports, real-time escrow analysis, etc. The list doesn't really end. And you'll hear a little bit today about our compliance assurance, which is done with a 3-tiered approach, which Shana will be talking about. We have a very proven and demonstrable track record in success that we deliver for our clients and our customers. And I'm going to be talking a little bit about that later. We have a high customer satisfaction rate of 99%, first call resolution rate of 91%, and a net promoter score of 83, although 84 last month. It really is a stellar score. And for our clients for subservicing, we have streamlined communication with a dedicated account manager that meets all of your needs. And I'll be talking a little bit more about all that stuff a little bit later. Let me turn it over to Shana.
Good morning / good afternoon, depending where you are. I'm the Chief Risk Officer at Servbank. I've been with the organization for going on 7 years now. My background is, I like to say, I am a regulator turned to outside counsel, turned to inside counsel, turned into a business person. So here today to talk to you mainly about risk. So whether you're buying or selling MSRs, whether you're servicing yourself or outsourcing to a subservicer, things you want to think about, questions you want to ask, giving you those inside tips about what's important.
Great. Thanks, Jason and Shana. And we're going to kind of divide up the presentation here in 3 parts, probably 4 parts. Everyone knows I'm not that good with numbers. Jason and I are going to kind of handle the front part, and the meat of it's going to be both Shana and Mignon talking a lot about the subservicing issues. And I'm going to come back and wrap up with some macro themes that are going on in the mortgage market. So, and some mortgage benchmarking and trends. So let's go to the next slide. As we kind of do a quick survey of the industry and where we're at, I pulled some mortgage headlines. We're almost at the end of Q3. I'm not sure where the summer went, but the Q3 headlines may not be as positive as they were for Q2. We just pulled some, from a lot of sort of large publicly traded companies, but generally speaking, Q2 was a better performance than Q1. People were profitable in Q2. Q1 was not so much. The general theme is Q3 is probably going to be a struggle and Q4 is going to be a struggle, but both volumes continue to be an issue, i.e. there's not as much originations out there, and overall profitability continues to lag. And there's a lot of reasons why profitability is lagging out there, but it'll be interesting to see how the second half of this year goes. We're 3 weeks out from Philly at NBA Annual, and it'll be interesting to see what the theme was. Coming out of New York, people were like, hey, it's getting a little bit better, seeing that increase in volume. We saw that in Q2. Now, I think as we enter Q4, people are like, oh, it's going to be the winter months and volumes are going to be tough again. And, when it comes to that, and I always want to emphasize, we've got a great subservicer on this call. Managing those risks is really important in your servicing portfolio. So not having those exceptional losses, having that great performance is critical, sort of the profitability if you decide to retain servicing. If we go to the next slide, as we think about, this is just some public data that I ripped through financials on, and it does show sort of the similar trend here. This is banks, and this is either calculated or fully disclosed by them in their financials. I always point out this, when you look at like a PNC or like a Regions Bank, those tend to be very specific retail originations that they're doing. And again, this is gain on sale, not necessarily profit margin. And then those that tend to participate in more of the third party channels, the correspondent channel, which I don't know if Jason wants to comment about the volumes that they're seeing through their correspondent channel. But those channels tend to be a little bit thinner in margins than retail traditionally is. But year to date, obviously it's been a challenge. But the banks are hanging in there. They tend to do a lot of jumbo products. They tend to do a lot of some of the lower credit quality. They're refocusing their origination side of the business, but those that participate in all the channels tend to have lower margins. And Jason, I don't know if you've got, everyone knows I don't stay on script, but Jason, from a correspondent side, I don't know if you want to make any comments about what you're seeing across the Servbank platform.
It's down. Let me just say that.
It's down. It's not going up. And the next slide, if we go to the volumes, the volumes tell a real story as we start thinking about this. I guess the good news is volumes are up from Q1, but if we look at kind of a linked quarter basis, down almost 54%, right? And if we go back further in time, boy, it's really tough to remember 2020 and 2021 at this point, though. Full disclosure, I did get a COVID booster over the weekend, and boy, the new booster is rough, man. It was about 36 hours of not feeling so great. Doing much better today, but as you think about the volumes, we're doing about a third of what we did in 2020 and 2021. And Jason, to your point, volumes are down, staffing levels are down. The challenges are really present on that origination side of the business, and that is likely continue for a couple more quarters here. If we go to the next slide, we're talking a little bit about mergers and acquisitions. Obviously, Richey May is active in this space. There's other firms that do this. And look, there's a lot of still capital coming into the market. And I think this is always an interesting dynamic, whether it's people starting to retain servicing or getting into the mergers and acquisition space. The market here continues, and the rumors are out there across the industry right now as to more M&A activity. But some banks are getting in, some banks are getting out. Some banks are shutting down channels, some banks are expanding, some IMBs are expanding. New companies are popping up, new capital is coming in. So it's not all doom and gloom on the mergers and acquisition space, right? People are interested in mortgage in general, and they see this sometimes as an opportunity to come in at a lower cost point when volumes are down, and hoping that they'll pick it up when the volumes are up. So again, a lot of mergers and acquisitions. There's tech mergers going on as well. So seeing just that consolidation and that shifting around of capital. I'm going to turn the next slide over to Jason to talk about some delinquency trends that he's seeing in the industry, and I'll come back and wrap it up before we turn it over to Shane and Mignon.
Yeah, I mean, look, there's not a whole lot in here that you guys don't already know that are on the call. As you can see, national delinquency is low. It's like really low, historically low. This is fairly consistent with really all product types. And it's consistent with the 30-60 bands and the overall total DQ, really, with only the 90 plus being at elevated rates. If we can go to the next slide. Yeah, and some fancy charts that show you basically what you just read and I stated. As you can see, after the increase with COVID, well, about 2 years from the start of the pandemic, and have been, slowly plodding along at these record lows ever since. Obviously, this trend matched the improvement in the overall macro economy and was aided by what I must say is actually some pretty effective and timely borrower assistance programs. Definitely learned their lessons from HAMP, that's for sure. But look, hey, you guys don't need to tell me what you can already see publicly. What you probably want to know is where is DQ heading? And to that, I say, I don't know. I knew precisely where they were going. Well, I guess I probably wouldn't be on this call. I'd be sitting on a beach somewhere. But I can say this, that provided there is no black swan event, it is unlikely that we will see accelerated moves in DQ either up or down. But for example, if DQ does start to trend up, we would be looking at a slow increase. That being said, the unexpected does happen, and it usually happens at the least expected time. And if you are worth your salt as a servicer, or if you utilize one, you need to ensure that they are legitimately prepared for any change, slow or rapid in the economy, and what would be expected to be a corresponding rise in DQ. So, like in the case of an economic slowdown or a recession or some other event where delinquencies would be expected to rise, they should already have robust and dynamic collections and loss mitigation infrastructure in place that can scale to meet that demand, with a level of alacrity. Because the one thing I know about delinquency management specifically, is that once you let it get away from you, it can take extremely long time frames to get it back to where it should be. And at Servbank, we understand this, which is why we put in dynamic and predictive probability of default models for all of our strategies, auto dialing with self-service to amplify our ability to scale, calling in need, a full suite of digital notifications to borrowers, et cetera. The list goes on. And it's actually these tools and infrastructure that have kept and continues to keep our DQ at Servbank below the national averages for both Government and GSE loans.
And Jason, you've got a somewhat unique portfolio, right? In that you have a somewhat concentration there in the Ginnie Mae space. So,
we are heavily weighted in the Ginnie Mae space, and those tend to be the canary in the coal mine when it comes to DQ. We are starting to see a little weakness in that portfolio, as well as what I would consider the weaker bands of the GSE portfolio, those with private mortgage insurance. But again, nothing that sticks out over the top right now. But as a company, we are prepared for big moves.
Great. And as we all know, on the delinquency side, that has a huge impact on the servicing cash flows. If we go to the next slide, we'll look at MSR values. And again, this is through Q2. This is 8 publicly traded banks and their values. And the question I get quite frequently from the industry is, have MSR values tapped out? And the answer is, if they haven't, they're darn close to it. Most people that have retained servicing are dealing with sort of a split personality portfolio, right? If they've been in it a while, they've got some really low coupon that Jason can attest to is performing very well. Low coupon, a lot of LTV or low LTVs, highly performing loans. And then there's kind of the newer vintage book. And I'll say this in all nicety, most of that 2020 and 2021 value has already come through the income statement for these companies. There isn't a lot of upside left in that servicing. It doesn't mean it's a bad cash flow. It doesn't mean it's a bad asset. It just means there isn't a lot more upside to value. And then you've got the kind of the newer book, which, yeah, there may be some cracks in the delinquencies, but we could see on this trend line that, some of the values certainly appear to be getting tapped out. And in full disclosure, part of the little bit of a wobble here is many of the banks are actually executing what's called excess servicing trades, where they're sort of taking MBS servicing that has higher than 25 basis points and creating true certificated IO. There's been over $1 billion of those trades this year, and they're selling that excess servicing. So when they reduce their servicing fee, the value comes down on their portfolio in terms of basis points. And that's some of this little bit of wobble that you've seen in 2023 so far. And there's been more trades done here. This is good. We're going to pivot now over to both Shana and Mignon, who are going to talk about some much more specific kind of servicing issues around MSR purchases and some areas of concern. And I'm going to come back at the back end of the presentation and do some cleanup. But Mignon, I'm going to turn slide 16 over to you and Shana and let you all rock.
Okay, all right. So a few things to consider with MSR purchasing. One, servicing transfers can be complicated, so definitely you want to have a plan. You want to have a plan to move those loans over and work with the servicer that you plan on utilizing, whether the loans are currently with the subservicer that you're going to keep or whether you're going to be moving those loans. So if you're moving those loans, you definitely want to vet out a new subservicer to move those loans to and have a plan in place on how you're going to get the data transferred. And you want to prepare to have an initial uptick in consumer complaints. Usually there is a small increase in the number of complaints that you get after a service transfer. And then you want to also make sure that you're confirming the loan count and balance with the MSR analysis, make sure everything is in alignment there. Of course, you have to notify the consumers of the pending transfer. There's a lot of different things to consider here. And I guess we don't have to go through every single point here. One thing, though, that I think sometimes is kind of an issue with service transfers is making sure that that data is in the format that it needs to be in for the subservicer that's going to be that you're moving the loans to. So making sure that that data is in the format and the definition of the fields is correct for the new subservicer is key. So that they can service the loans properly, and then also having the documents and the images that the subservicer needs in order to properly service the file. So those are definitely some key things to consider. And then as Jason spoke about already, delinquent loans, if there are delinquent loans in the portfolio that you're purchasing, make sure that the subservicer understands that and that you're able to provide numbers to them, because they're going to need to make sure that they have the capacity to handle those. Those are definitely high touch loans. You want to make sure that the subservicer has a scalable process for that, and that they have a good process for in-flight loss limit loans coming over. Anything that you want to add, Shana? I know this is a complex process. I'm sure you have a lot to add.
Yeah, so it's funny because I was thinking about what Seth and Jason just said about the state of the market, and we've been planning this webinar for the past month, and it's like any given day when we talk about the state of the market, how much doom and gloom are we talking about, right? And so I was glad to hear a few positives in there, right? Delinquencies being low is always positive as long as you're managing those in the right way. The MSR sales upticking is a good thing. And so I just, we're looking today, it seems like every time you come in, you check your email, you check the industry news, it's, somebody else is riffing people, they're cutting team members, maybe they're going out of business, they're going through an M&A, which could be a good thing. And I think a lot of us are asking ourselves the question from a risk perspective, how do we stay in business? how do we take the resources that we have and focus them in the best way to get us through this long winter? And when you're talking doom and gloom, I'm just thinking maybe it's the season, but I just hear like Game of Thrones in my head, like winter is coming, winter is coming. And how do we as an industry weather that winter together? And so what I want to hit on here are, from a risk perspective, what you can do in terms of whether you're buying or selling your MSRs, or you're servicing in-house, you have a subservicer, but you need to perform that oversight. What should you be looking at? What are those questions? And ultimately, it comes down to a couple of things, right? So one is going to be your cost to service. And so when you're looking at these controls, you always want to be looking at either your cost or your subservicer's cost, and how much of that is coming back to you or being charged back to you. And then Jason's going to talk about the customer experience in a little bit too. So a couple of things about MSR purchasing. If you are buying MSRs, I want to start with best practices, which is know what you are buying. Do not go in blindly. So I'm going to suggest a couple things that we have done in the past on MSR purchases, which is you need your data and you need your documents. And so depending on what your volume is of purchase, you want to have some sort of team or automation with eyes on those loans to say, do you have the critical documents that you need to service that loan? If you don't have your note, your deed of trust, your allonges, and sometimes if you're looking at those age vintages that Seth was talking about, you might not have those, and make sure you're pricing that in, because that's something that you need to service the loan. And ultimately, as the MSR holder, you're responsible for that. So even if you use a subservicer, if you don't get them the note, if you don't get them the documents that they need to prove certain things along the life of that loan when it comes to servicing, you're going to be the one that's held responsible with the agencies, with your regulators. And so you want to make sure that you are doing some sort of sample to have the documents. Same thing with the data. Data integrity on the age loans can be a serious problem. I know Mignon was talking about the boarding tape and making sure you're testing things if you're moving to a new subservicer. Even if you're with the same subservicer, the data tape is always changing, right? We know the one constant in this industry is change. The regulations are changing. We just had new SCIF data. We're always going to have something new on the boarding tape, right? And so you want to be testing your data integrity to make sure it's accurate, because when we're talking about things like, now we're going to have all these ARM changes. We just went through the LIBOR change. So make sure, one, you have the documents, and then two, the data in those documents is accurate. And if that's something that maybe you're not set up to do, if you're a smaller shop, if you don't have the resources, ask the subservicer that you're using, ask them about their data to docs process, ask them about their OCR, ask them about the technology that they have to validate those data points for you. So that's a big one. The other thing I want to hit on here, we're going to talk about complaints in a minute, but the statement here, prepare for an initial increase in consumer complaints. I want to say, okay, prepare for the worst, but if you have a good subservicer, you probably won't experience this, or you will not experience it as much, because the process of a customer going through a servicing transfer, as we know, can be painful. It's not something that the customer gets to choose. They don't choose who buys or sells their loan. They don't choose what happens to the servicing. That being said, as much as you can control the process, and I know one of the things that we do here at Servbank is we match our clients together. So we know if we have clients who are looking to sell MSRs or buy MSRs, a way to facilitate those transfers so there's no impact to the customer, because they're not leaving our servicing platform and they don't have to go through the onboarding, deboarding, reboarding process. But even if you are changing servicers, if you have to sell to somebody else, think about the process from that customer aspect. And so from an oversight perspective, you want to ask, what is the process for somebody coming on board? And don't just tell me about it, show it to me. So let me see what those communications look like. Do those communications make sense to me as an average borrower? Do I know what's going on? What are the ways that they have to reach out to escalate things? And I'm going to put a pause on that because I know Mignon and I are going to talk about complaints and escalations in a minute. But I think it's really important to actually understand the customer experience that they're going to go through, because that is what is going to manage your collections. That's what's going to manage your delinquencies. And those communications are critical. And then the last thing I want to say here is the in-flight process, because not only are we seeing an uptick in a lot of the MSR sales, but in particular, MSR sales on delinquent loans. And maybe that's because delinquent loans seem to be our specialty here. We're really great at keeping those delinquency rates low, getting people back on track. But if you are looking at buying or selling MSRs where the loans are delinquent and you have a large volume of customers who are in loss mitigation, you want to make sure you understand not just the boarding process, onboarding and deboarding for a regular customer, but for a delinquent customer. And I know one of the things that we do is everybody sends a hello goodbye letter, right? You're required to do it by RESPA. There are certain things that need to be in that letter. But what else should be in that letter that's not required? And so our letters say things like, if you're in loss mitigation and you're coming to us, here are the things you need to do. Or if you're in loss mitigation and you're leaving us, here are the things you should do. Or if you're receiving half funds, here are the things you should do. And those are considerations for the flow of information, not just between servicers, to make sure that it's a warm handoff, but you're letting the customer know too. And so just keep in mind, if you're going buying or selling delinquent MSRs, not just what is the boarding process, but what's the handoff through the loss mitigation process.
Yeah, I love that proactive approach of adding additional things to the transfer letter so that the borrower is aware of what steps they need to take. I think that's a great idea. So yeah, let's talk about consumer complaints a little bit more. There's a lot of regulations around, how you're supposed to handle consumer complaints. So wherever you have your loan serviced, you want to make sure that they have good policies and procedures for this process. And like Shana said, they need to have an escalation path that's available to borrowers, including those borrowers that are either already in default or some type of loss mitigation process, or that they're facing that imminent foreclosure. Also, you want to have an escalation path for you as a client. So sometimes you may get wind of certain consumer complaints, and you may want to escalate to your subservicer that complaint or follow up on it. And so you want to make sure that you have a path to escalate anything that could possibly go wrong with one of your customers. And as part of the due diligence for your subservicer, you want to make sure that they have an SLA internally that they're adhering to as far as responding to and resolving consumer complaints. So definitely there's a timeline that they have to adhere to as far as the regulation, Reg X, but internally a lot of times they have tighter timelines as well. And so just knowing that your subservicer has an internal SLA, that they're really beating those regulatory timelines, I think that's really key, because they're trying to go above and beyond for the customer. And I think that's a proactive approach to keeping customers happy. You also want to make sure that your subservicer is kind of looking at all the data for complaints and doing trend analyses, and trying to find the root cause of every complaint, see if there's any trends there, if there's anything that they can improve in their processes, and be open to making those changes. Even if they're not regulatory in nature, but you could have a trend in a customer complaint that's just something that could be an easy process change, or maybe it's not even an easy process change. But just knowing that your subservicer is looking at those things, taking them seriously, taking action when they can, when it's feasible, it shows that effort on their part to making the customers happy. And definitely you want to make sure that informal complaints also have a process, right? With social media now, there's a lot of avenues for customers to complain. They may not always complain through the Better Business Bureau or the CFPB, right? They may be posting something on social media, and there are ways to monitor that. So make sure that your subservicer is monitoring social media and other channels where your customers may put like an informal complaint out there, and that they're able to identify those and address those complaints as well. I think that is a good way to proactively keep your customers happy. And Shayna, anything you want to add on this? I'm sure that this is this is always a fun topic. So.
It is. And look, we definitely want happy customers at the end of the day, but I'm going to take it back to cost, right? So if you reduce your number of complaints, you're reducing your cost to service that loan. Complaints can be such a time vampire. If you have noisy customers because something is broken or they think something is broken, they can come back again and again and again. And that's a drain on your resources, on your time, and on your team members. So that's the first reason you should care, right? The second reason is what we've seen, and I'm pretty plugged in with our friends over at the CFPB, the FDIC, the OCC, all of our favorite acronyms. What we've seen over the past few years is really this shift when it comes to expectations for consumer compliance, where it used to just be an expectation that you had a process over your formal complaints that were coming in through the regulators. And now they've sort of widened the aperture of what that looks like to say, tell me what else you're seeing. So yes, you have a formal complaints process, but what about social media? And what about if somebody calls in? And what about your chat bot? And what about all these other mechanisms that we have to communicate with customers today? And so it's really, it used to be the sliver of what we would deal with on complaints, and now it's the whole customer experience. And what I will say is that your complaints have the ability to give you the canary in the coal mine on larger issues. You know, we have a way of escalating, we call it an unhappiness tracker. If somebody calls in, and it might be something as silly as, I don't like the colors on your website, or I don't like your hold music. And it's like, okay, fine. You know what? If we have enough people complain about it, maybe we'll change it. But what we're really looking for is the nuggets of, you use a notary and they didn't show up one day, or maybe you use a vendor to send documents and they didn't come to me on time. And those are the things that if you can identify them early on in the process, you can change those processes upstream, so you're not going to get 10 about it. And that's what's really key here. And I kind of take this back to solving your own problems, right? I have little kids, and this is the difference between them resolving something with their classmate who sits next to them versus going to the teacher versus going to the principal. And we always try to do the like, solve your own problems, you'll be proud. Also, I don't want to talk to the principal today because I have plenty of other things to do at work. It's the same mindset. As somebody that sits over risk and compliance, I don't want to constantly be in contact with our regulators about what went wrong or why a process was broken. I want to find it upstream and I want to fix it. And I never want that issue to become a complaint. And so when you're looking at either your own portfolio or you're looking at oversight, you want to know not just what's the formal complaint process, but look what comes way before that to see what's the data and analysis, so you don't get those complaints and you don't get those calls from the regulators. And the other thing I want to say about the escalations, Mignon, you said also not what is the customer experience, but what's the client experience. We have a large number of clients that we private label service in the name of the client. And so that customer doesn't know the difference between calling us as the subservicer or calling their mortgage loan originator, or calling, you know, walking into the bank and talking to their teller. And so you want to know, particularly if you are private label and you're using a subservicer, what is their escalation process for making sure those issues get to somebody? What are their SLAs for response? And what can you expect in terms of transparency of viewing that as it kind of progresses through the system or through the process to figure out what went wrong and get a response back to the customer?
Yeah, I think that's very important. All right, so moving on to Ginnie Mae advances. We'll talk a little bit about principal and interest advances on Ginnie Mae pooled loans. So just as a reminder, issuers remain obligated to make the full payments of principal and interest to investors while that loan remains in the pool. and loans can be bought out of the pool upon default, and that's typically on that third missed payment. Also, just something to keep in mind that there is a timing difference. So there's usually float in the paid in full and incremental principal payments, and that can sometimes mask your cash advances. So definitely something that you want to make sure that you have a good understanding of, and that you're able to stay on top of that. If you have a lot, or if your portfolio is made up of a lot of Ginnie Mae loans, there could be significant advances, especially with defaulted loans. So just something to keep in mind, and making sure that you're aware of it and keeping track of that, and knowing that those advances can be masked. So you may think that you're okay on advances, and then later find out that you have more out there in advanced funds than you anticipated. So something to keep in mind and keep track of. And Shayna, I don't know if you have anything you want to add on Ginnie Mae advances or not.
I do, but I'll let you get through the next slide first before I chime in.
Okay, yeah. All right, so going on with Ginnie Mae advances, now remember that on the back end, you may be able to recover a lot of those advances on your HUD claims. So a few things though to consider as you're looking at your delinquent portfolio and talking with your subservicer. You want to make sure that your subservicer has a solid claims process. It's very important. A lot of money can be lost on the claims process if it's not done correctly and timely. So first of all, HUD maintains a schedule of allowable expenses that needs to be followed, needs to be something that you're aware of. There's servicing milestones and reasonable diligence timeframes that must be met in order to recover all of your claim funds. There are certain things that can be curtailable events. If they're not met timely, then you're going to lose money there on the claim. Any excess fees and costs over and above the schedule of allowable expenses. So say if it's a contested foreclosure and you have to pay additional attorney fees that are not on that schedule of allowed expenses, you have to submit approval and get that approval in advance for some of those items. If you don't get that approval, you may not be able to recover those money, that money on the back end on the claim process. If you are not going to meet certain milestones that are required, you've got to submit an extension request, and you have to do that timely, and that extension has to be approved. So there's a lot of things to consider here. Also, your HUD tier ranking is also a factor here. So just making sure that you understand these things and make sure that your subservicer has a good process for this. Otherwise, money's being left on the table. Also, another thing to understand too is who's keeping the incentives for loss mit. A lot of the agencies have certain incentives for different loss mitigation, like modifications and certain things. So who's keeping those incentives? Are those being passed through to you as the MSR holder? Is your subservicer keeping those? Are you splitting those? Understand that. What's in your contract, and that's also something that you could negotiate as you're vetting out and signing a contract with a subservicer, something that you want to pay attention to. But basically, they need to have a good claims process. So something that you really need to hone in on, especially if you have a high delinquency in the portfolio, and if there's a high percentage of Ginnie Mae loans. So, all right, I'll kick it over to you, Shayna. I know you have a lot to say on this.
I do. I'm going to try to be quick in the interest of time. I'm going to say we just have like 3 words on one slide: advances, claims, and loss mitigation that generally make everyone's eyes glaze over. Seth and I like to say servicing is a deep, dark place because it's very complex. And there are a lot of lenders and originators out there that do not have deep servicing knowledge, and that's why they outsource it. And that's perfectly fine. But what I want to point out is, like, you might even understand servicing, but when we get into claims and loss mitigation waterfalls and incentive payments, that's like a whole nother level of servicing. And so typically this is something that gets looked at by maybe your CFO, by your accounting or finance department. I would encourage you to bring in somebody from risk and compliance that either understands these processes or has the ability to self-learn or get some training on these processes so you understand what the subservicer is doing from an oversight perspective, because like Mignon said, it can be money left on the table. And then the other thing that I want to say is if your eyes are already glazing over and this is something that like you don't want to touch with a 10-foot pole, ask the questions of your subservicer, right? At the very least, ask them to explain the process to you, ask them to explain the controls that are in place, ask them for transparency, the reporting you could see, because this is critical and it comes back to your bottom line.
Definitely. Yeah, and in the interest of time, we'll just go through this one really fast. There is a proposed payment supplement partial claim that FHA is talking about. We're not sure if that's going to be implemented or when, but something that they've put out there and asked for public feedback on. That new option would basically help subsidize the borrower's payments for a period of time. So that's something to look into. And if you feel like commenting on it, FHA is asking for comments. All right, I'll kick it back over to Jason now, and he's going to talk about KPIs and other industry things with subservicer industry issues.
Yeah, we're going to talk about key subservicing KPIs that are most critical to delivering the best borrower experience. But why don't we start by talking about what the borrower experience really is? Essentially, borrower experience emphasizes the satisfaction, the ease, the transparency provided by servicers in meeting the needs and expectations of borrowers. You know, it encompasses various factors such as, you know, issue resolution, communication, personalized service, convenience, etc. Now, to put it in layman's terms, it basically means, does the customer feel like you listen to them, resolve their situation timely, and most importantly, show that you cared about them as a customer or a person, for that matter. So let's look at how the industry traditionally measures, borrower experience. You know, we have our average speed of answer, or how quickly you pick up the phone, your abandonment rate, or what percentage of your customers hang up before they speak to anyone, your average talk time, how long you talk to a customer, and finally, your average handle time, or how long the entire call takes from answer to completion to documenting the file, the system, and that you're ready for the next call. And you know, these are all fine metrics that should be measured, as we do at Servbank, where we're always below the NBA averages, but they're not the complete story. You see, they are mostly, what these really are is they're really performance metrics of the agent and the call center itself, and they really do not speak to the actual experience of the borrower. These are more transactional in nature. But to gauge a true customer experience, there are some more additional, more meaningful metrics that I believe should be measured, and that we believe here really at Servbank. And that is let's start with customer satisfaction rate, or a measurement of if the representative who assisted you was friendly, knowledgeable, and professional. One call resolution, or the measurement of whether you resolve the customer's reason for calling with you on one call or the first call overall. And finally, the gold standard, the Net Promoter Score, which is really the measurement of how likely they are to refer us or you, depending on if we're PLS, to a family or friend member based on how we serviced their mortgage. Now, these metrics speak more to the emotions of a customer after they interact with you, and are a better measurement of how their experience was, because it captures how they feel about you, how they feel about you as a servicer. You see, people's opinions in decision-making, for that matter, which is what matters here, say if they want to refinance or buy a new house or use you as the lender who will All these things are driven by these emotions. So it's, in the end, it's not really, necessarily important on how fast you picked up the phone. It's really more about, did you care about them as a person? And as a servicer, that should be your first and most important stat that you are tracking. All the others are really just numbers. And to prove this point, at Servbank during the pandemic, when we, like everybody else, had a period of time in the beginning where there were very long wait times, 30, 40, sometimes 50 minutes. And you would think that such long wait times would automatically lead to a low net promoter score. However, we knew that if we focused on the emotions of the customer, listened to their story, expressed empathy, provided them with accurate information, and demonstrated that we could resolve their issue timely on that call without transferring them around, essentially, basically, that we cared about them, that they would have a great experience, and ultimately they would score us high in the net promoter score and forget the fact that they just waited 45 minutes. And it showed actually in our numbers, because our NPS scores went up during COVID and have continued at best-in-class levels at 84% ever since. But actually, don't take my word for it here on the importance of, evaluating emotion when it comes to connecting it with experience. Just think about the experience you had with anyone that you call. Maybe it's an airline, cable company, it doesn't matter. Think about the times you had to wait a long time and ask yourself, were you upset or angry over the fact that you waited a long time if in the end the agent resolved your issue on that call and did so in a way that made them feel like they cared about you? And I'm betting not. In fact, the only calls you likely did get upset or frustrated with are the ones where they treated you like, like a commodity, where the agent didn't demonstrate that they cared about you. And I'm betting immediately after that call, you complained about it, probably to the first person you spoke to. And maybe you didn't even give them a good review. In fact, you're probably compelled to go out and give them a bad review. That is why if you're trying to gauge if your customer, if you're truly giving your customers a great experience, you should track these legacy metrics that we talked about. But you also, more importantly, must rely on the emotional metrics such as the net promoter score that I just talked about. So if you as a subservicer or you use a subservicer and you need to ensure that they are all aces when it comes to the emotional stats if you want to retain them as a customer. And if they're not, or worse yet, they don't even track or measure those numbers, then honestly, you should look for a new subservicer, because you will be doing damage to your brand with your customers and losing that recapture opportunity, which we know is more important now than ever. We know this at Servbank. We can unequivocally say that our class-leading numbers, like the NPS score I talked about, in these more emotional metrics have directly led to higher recapture referral rates for our clients. Now let's move on, I believe, to the next slide, which is going to talk about the technologies that are critical to delivering this experience. So with that being said, what technologies are critical to delivering this top experience? Well, to my earlier point, when I define customer experience, the customers want it simple, easy, and convenient at every touch point. And that is more and more nowadays proving to be important, is the ability to comprehensively deliver them self-service. So that's like a website that looks and feels like it's from this century, an app that allows them to do everything from payments to escrow to submitting loss mitigation documents, an easily navigatable IVR that they don't get lost in or spun around in, an intuitive, meaning not dumb, AI chatbot that answers most of their questions, and if they can't, it immediately drops them to a customer service representative for assistance. You have to be able to meet nowadays where they're at in today's world. And I don't want to understate this. I can't understate this enough. You have to do all this in layman's terms so that they understand what it is that they're looking at and don't have to call you for clarification of simply what it is that they're trying to do from a self-service perspective. And I know that I prefer much prefer to knock stuff out like taking care of this stuff on a treadmill or while I'm watching Netflix, whatever the case may be. It's just so much more convenient. You have to offer your clients, so you can throw me in that intuitive self-service camp. Same thing goes for your internal systems. If you have a system for your agents and back-end staff that is simple, easy, convenient, and again, can't reemphasize this enough, in layman's terms, they will be able to assist your customers and complete their tasks far more efficiently than if they, they'll be able to complete those tasks far more efficiently, and it creates that environment to deliver that best-in-class experience. Better yet, if you have a central ecosystem, which drives both your customer service technology and your internal service technology, like we do at Servbank with our SIMI system, then not only do you create that environment to deliver that experience, but you actually set the table to do so. But notice how he said just set the table, because in the end, all this technology doesn't matter if you don't have the lowest tech, most effective and impactful solution of all to utilize it, and that is quality people. Yes, us humans are now underrated, or I mean, we're so underrated nowadays. But you got to have quality people, and those quality people must be immersed in a quality and caring culture. And hopefully, you guys are catching a theme here, because in the end, it comes down to people who care, and that is a top-to-bottom, complete cultural focus that a subservicer or a servicer must have. They must bring aboard cultural fits who believe in your mission of caring. And a company from escrow to cash to MSP admins, to customer service agents, all over the board, because you have to have it in the bloodstream, because in the end, that's what translates into a customer service agent delivering a genuine, committed, and caring smile on every single call. And as was noted earlier, or if you don't, or your subservicer is not delivering that caring experience, you're damaging your brand, and you're losing that recapture opportunity. Look, I always say there's two things you can't pick in life. One is your parents, the other is your mortgage servicer. And on that basis, you have a responsibility as a servicer to invest in the intuitive technologies like we do here at Servbank with SIMI, to invest in your people, to invest in your culture, to invest in delivering a great customer experience, all the things that we invest in Servbank, because we know in the end that investment will pay off for us as our clients, for us as a servicer and our client partners. And, not to mention, it's just the right thing to do. It's just the right thing to do. All right, let's talk a little bit about the biggest challenges that subservicers are dealing with today. The first two here, market fluctuations and uncertainty and increased transfers, they're really tied together. Well, more of a cause and effect, I guess you could say. The market fluctuations are primarily impacting the originations world, are obviously traveling downstream to impact servicers. There are many impacts, but the primary one is the increased movement of loan transfers as lenders sell off MSRs to free up liquidity. I know this was talked about a little bit earlier in the webinar here. And, loan transfers they're a four-party affair. You have the MSR owner, you have the transferor, and the transferee. And then, of course, the most important one of all is you have the customer. And when you're dealing with four parties, things can get dicey, which can lead to frustration all around. And the only way to truly mitigate this challenge is to have a hardened and radically proactive client setup, flow boarding, and bulk conversion process like we do at Servbank. I think Shana touched on this a little bit earlier in the presentation. One that proactively and frequently engages with all parties early and often, says clear communication, and I think Mignon talked about this, very clean data as well. And as I touched on earlier, then plenty of layman's terms communication with the customer about what to expect and when. So next in line, I think we have vendor performance. Look, as servicers, like it or not, we have to rely on vendors to some degree. And their performance standards, response times, et cetera, they may not align with your expectations or even with what they're actually contracted to do. This can impact the experience you deliver to your borrowers and your clients and can, ultimately cost you money. But in the end, you can't get away with placing blame on vendors to your clients, because you as a servicer, you own that relationship. At Servbank, we know this. So we don't blame, we don't abdicate. We know we own that relationship with the customer and the clients. So we engineer solutions to ensure that our customers and clients still get that best experience regardless of the vendor performance. And you should expect that of your subservicer. In fact, you just should demand that ownership and action, and do not accept the blame that they might place on their vendor as an excuse. At Servbank, we want to ensure that experience, at Servbank, to ensure that experience, we place what we call bubble wrap around those points that exist, or we don't control the entire process, to more or less protect the experience that we want to deliver. This bubble wrap primarily consists of extra layers of oversight, more frequent calibration meetings, triple validation checks, or in some cases, we take the entire process in-house where we feel that the vendor cannot meet our standards. It's like a perpetual trust but verify philosophy on steroids. And this approach allows us to definitively say that regardless of the situation or circumstance, that we still deliver a frictionless, top quality experience for our customers and clients, regardless of how the vendor may perform in the ether. So next on the list is employee retention. And look, everyone in the industry faces challenges of quality employee retention, and there's no way to prevent losing quality people entirely. But I can say that if you can, that you can mitigate it, because if you don't take care of your people, trust me, your competition will. And how you do that lies in you as leaders of companies. Study after study, survey after survey, all point to the same thing. You have to provide a culture that invests in your people as whole people, like we do at Servbank. In fact, it's our first core value. People matter, period. So you as a servicer have to provide a culture that employees want to be a part of, a culture that features things like an engaging and promoting, that engages and promotes work-life balance, one that recognizes and rewards your employees for their hard work, a culture that builds employee engagement, and one that fosters growth and personal and professional development. But above all, it starts first by hiring people that are cultural fits, assuming that you have a good culture to start with. And if they do not match your culture, it will never work out. Let me say that again. If they are not a cultural fit, no matter how much you try, it will never work out. So if you've made that mistake, or when you discover it, invite them to find success elsewhere and do not wait on that decision. The last bullet point here is the legacy mindset. And what I really mean by that here is that too often in the servicing industry, I hear words like, we can't, or that's the way that we've always done it, or it's too expensive to do X, Y, or Z. To that, I say hogwash. I guess maybe I'm dating myself by using the word hogwash, but to me, in the end, that is just an excuse. If something is important to you as a company, if it truly matters to you as a company, if you truly care as a company, you have to just commit with every fiber of your being, with the full might of your entire organization as a servicer, as a leader to change and advance what matters most, to what is meaningful, to what is right, and to ultimately what is going to benefit your clients and your customers, and then work your tail off to engineer that outcome you want. And yeah, I know it might take effort, might take a little money, but in the end, it just takes grit. It just takes grit. At Servbank, we're committed to challenge the status quo at all levels, because we know and have proven that it's that grit, that commitment to creating excellence in everything that we do, that pays dividends for our customers and our clients in the long run. So those are my points on the challenges that servicers are dealing with. We turn it over to you, Seth.
Great, thanks, Jason. And as the entire team at Servbank has talked about on this call, and Mignon as well, there's a lot of challenges out there. Making sure you've got the right partnership, making sure you've got the right oversight, making sure you got the right data. When Shana and Mignon started talking about data, I was getting chills. The hair on the back of my neck was standing up, just knowing how sometimes data on the servicing side could just be an absolute disaster. I know we've run a little bit long in this presentation, so I'm going to go through these last slides kind of quickly. But we do want to thank Servbank for sponsoring this, and I'll walk you through these kind of final slides pretty quickly. I mean, obviously, as we've talked about, rates are up. They've gone up historically fast. And I think that's really one of the challenges that the industry is facing right now, is that, in 2022, rates just went up so quickly that originators weren't able to pivot. And that led to a lot of the transfers that obviously Shana and Mignon and Jason talked about, right? There's a lot of servicing transfers as people had to monetize that servicing asset for cash in order to help sort of fund their operations. As we sit here in 2023, I know Jason and Shana would agree that, we're at a point where people have sort of right-sized originations. The problem is there isn't enough volume to sort of cover the lack of originations. So as we go forward, and where does prepayments come from? I think this is a great slide that is from the Urban Institute using Fannie Mae data. But that little sliver on the top of green is really 6% mortgages and higher. So as Jason has already talked about, right, that's the portfolio that may be a little bit more delinquent. There may be a little bit more cracks there, but so much of this servicing is ultra low coupon that there just isn't a lot of refinance activity. And so, any spike up in delinquencies, as Mignon was talking about, can cause you to be in an advanced position on your Ginnie Mae. So just something to be aware of. I say this as a consultant, actually the bigger that sliver of green gets, the better the refinance cycle will be. But it's real painful now with rates above 7%. One of the other issues that's out there is affordability, right? And this is a great graph that we stolen from Leonard Kiefer at Freddie Mac. And I think every presentation I do, I steal at least a couple of his materials. So if you don't have to follow me on LinkedIn. You should follow Servbank, but you should definitely follow Leonard Kiefer. He's got some great visualizations here, and this is just affordability. And as we know, there's been such appreciation of housing, which is having a positive impact on delinquencies, as we talked about, but it's causing lack of affordability. And so again, we kind of need mortgage rates to kind of migrate to the left here for affordability. When we were on site doing the Servbank due diligence for our clients on oversight, we had talked about this, that, the affordability was a big problem, and actually housing should have depreciated, and it didn't. So again, making sure you've got a partner that understands the dynamics of the mortgage industry, I think, is incredibly important for a subservicer relationship. And finally, and if you're still hanging in there with us, Basel III Endgame, something to talk about when it comes to capital rules. Look, this is the proposed rule. It has a big impact on the mortgage ecosystem if this is not changed. The comment period is out till November 30th. Obviously, work with your trade groups, work with the MBA, work with people on this. But right now, banks will be impacted by this, and you're going to see some people potentially exit a channel like the correspondent channel. You may see other people exit a Ginnie Mae financing or financing MSRs or warehouse lending. So make sure you've got well-established partners and have constant lines of communication. Just as you want to have constant communication with your subservicer as to what they're doing, your partners here that are providing you cash is equally important. So make sure that you're aware of this. Stay tuned. These rules could change. The comment period is open until November 30th, but there is a big fear that this could cause costs to go up in the mortgage industry, some people to exit, and that creates opportunity that we talked about earlier in the M&A slide. Sadly, we have kind of run ourselves out of time here for question and answer, so we will respond back to any of those questions that we've gotten in through the chat directly with you. But once again, we'd like to thank everybody for their time today. Hopefully you've learned a lot about how to kind of manage that subservicing relationship. We appreciate the team from Servbank jumping on this call, sponsoring this call. We appreciate the partnership with you, and thank you for your time today. And Jason, I'll turn it over to you to close it out.
Yes, I know we ran a little long today. I appreciate everybody sticking around for the final slides here. Again, I think it was a great presentation. As Seth noted, if you guys have any additional questions, please send them over. And you can hear for Servbank. Look, if you guys are looking for a quality subservicer that is going to provide you the utmost in performance, in deliver a genuine, true partnership, give us a phone call. We'll be happy to talk to you. Come down, see our culture, see what we have to offer. I look forward to hearing any questions that you guys might have. So thanks, Seth. Thanks to the Richey May team. And we'll say goodbye. Take care, guys.
Thanks, everybody. Bye.